All right, let's dive into one of the most volatile and frankly potentially lucrative tax credits out there right now, the Alternative Fuel Vehicle Refueling Property Credit. You probably know it as Section 30C. The Inflation Reduction Act didn't just tweak the rules here. It basically created a minefield of both opportunity and serious audit risk. So we're going to break down exactly how to navigate it.
So here's the big question on everyone's mind, from tax pros to developers. How in the world do you claim this massively expanded credit for EV chargers without having the whole thing thrown out on audit? Because the stakes are incredibly high. One mistake can trigger a catastrophic disallowance, leading to a huge immediate tax bill. And that's exactly what we're going to tackle.
Here's our game plan. First, we'll cover the high-level audit alert for Section 30C. Then, we'll get into the weeds of how the IRA completely overhauled the credit. After that, we are going to dissect the absolutely crucial IRS definition of a single item of property, cover the two non-negotiable rules for geography and labor, and finally, lay out the accounting strategy you need to survive IRS scrutiny.
Okay, let's set the scene here. The changes to Section 30C have created this environment of, and this is the best way to put it, unprecedented statutory volatility. What does that mean? It means there's a huge potential upside for sure, but it is matched by incredibly complex rules and very, very real risks of complete disallowance if you don't follow them to the letter.
And just to be crystal clear, the IRA didn't just fine-tune Section 30C, it really performed major surgery on it. It fundamentally rewired how the credit is calculated, who can even claim it, and what's required to get the maximum value. This blew the doors open for an aggressive expansion of the credit's potential, but the new rules are strict and totally unforgiving.
Now, this slide points to what is, without a doubt, the single most important change the IRA made. It completely shifted the entire limitation framework for the credit. You see, before, the value was capped based on the physical address. Now, it's based on something much more granular and much more powerful.
And this slide lays out the difference perfectly. On the one hand, you had the old pre-IRA world, a hard cap of $30,000 for an entire project at one location. That was it. But now, look at this. Post-IRA, that cap jumps to $100,000, and, this is the key, it applies to each single item of property. For a big charging depot, this isn't just a simple increase, it's an exponential multiplier on the total credit you can claim.
So yeah, that $100,000 figure, that is the absolute game changer. It applies per item to depreciable business property, which is going to cover pretty much all commercial EV charging projects. This is the number that has everyone's attention, and for good reason.
Now, just so we're covering all the bases, it's worth noting the law also has a much smaller, $1,000 maximum credit for non-depreciable property. This is what you typically see for a charger someone installs at their personal home. It's a 30% credit, but it's capped at that $1,000 limit.
Okay, so since the entire credit now hinges on that one little phrase, single item of property, understanding exactly how the IRS defines it is, well, it's everything. Their proposed regulations, specifically REG 118-269-23, are the roadmap to unlocking this credit's full potential.
First up, let's get our terms straight. The IRS officially uses the term 30C property to describe anything that's eligible for the credit. And you got to remember, this isn't just the charger box itself, it's a whole bundle of components that are functionally interdependent, meaning they all have to work together to get the job done.
And here it is. This is the $100,000 definition. For electric chargers, a single item of property is each charging port. This clarification from the IRS is critical. It means if you have one single charging unit that can juice up 4 cars at the same time, that's considered 4 separate items for the credit limit. The credit is literally based on how many vehicles can be charged simultaneously.
But it doesn't stop there. The IRS also says you can include the cost of associated property in your calculation. Think of things like the switchgear, transformers, and even the concrete pads, stuff that's essential for the charger to work. The key, though, is that costs for any shared infrastructure have to be allocated on a ratable share basis to each individual port. And you better believe an IRS auditor is going to be looking for that precise, defensible allocation.
Okay, before you could even think about calculating the numbers, every single project has to pass through 2 very strict gates. The first is where you build it, and the second is how you build it. If you get either of these wrong, the credit is a complete non-starter.
First up, geography. Under Section 30C, CC3, the property has to be placed in an eligible census tract.
This is a simple pass-fail test. It needs to be either a low-income community, using the same definition from the New Markets Tax Credit Rules in Section 45DE, or a census tract that's considered non-urban. The IRS has mapping tools for this, and trust me, there's absolutely no wiggle room here.
The second gate is labor. And just look at this chart to see why this is so incredibly important. The base credit you can get is only 6%. But if you meet the prevailing wage and apprenticeship requirements, the PWA rules, that credit gets a 5x multiplier, jumping all the way up to a full 30% of your costs. It's a massive, massive financial incentive. But, and this is a huge but, there's a severe penalty. If you claim that 30% credit, but then you fail a PWA audit, the IRS doesn't just knock your credit down a bit, they execute a total disallowance of that bonus amount, sending you all the way back down to the 6% base. That can create an enormous and immediate tax deficiency. Your compliance has to be perfect.
So with all this complexity and all this risk, how do you actually manage it? The most effective way is what the source material calls the Decoupling Audit Strategy. And what that really means is you have to stop thinking about the project as one big asset and start applying an engineering mindset to your tax accounting.
I love this quote because it just says it all. You have to stop thinking of a charging depot as one single thing. Instead, you need to see it for what it really is, a matrix of separate financial assets, individual charging ports, each with its own power conduits, its own share of a transformer. That is the key to surviving an audit.
So here's how you do it, broken down step by step. For every single charging port, you create a separate cost basis. First, you isolate the cost of that port. Second, you add any costs that are directly attributable only to that specific port. Third, you calculate its fair, proportional share of any shared infrastructure. And only then, once you have that final per-port total, do you apply the credit rate and the $100,000 limit. And you do this for every single port.
So when you boil it all down, it comes to this. Your ability to both maximize and defend the Section 30C credit is directly tied to the precision of your accounting. Meticulous cost segregation isn't just a best practice in this case, it is the fundamental requirement for claiming this credit and making it stick.
And that really leaves us with one final important question for you to think about. As these alternative fuel projects get bigger and more complex, you have to ask, is your tax and accounting strategy being engineered with the same level of precision as the physical hardware? Because under these new rules, one simply cannot succeed without the other.